This. Good morning and welcome to the session on the Companies Act, implications for the MSME sector. Thank you for your time today morning. I'm happy to be here and I'll take you through this presentation. So basically today we'll be talking about the new Companies Act and what it means for the MSME sector specifically. We will not be going into the various amendments in the Companies Act and its various implications for the companies in general. We will try to restrict this to companies in the MSME sector. So having said that, what do we mean when we say companies in the MSME sector? It means that micro. One minute, something coming on the screen. Okay, so MSME means the micro, small, and medium enterprises. The micro, small, and medium enterprises contribute to nearly 8% of the country's GDP. The ministry has a number of programs to assist entrepreneurs who have started businesses in this sector. So there are various institutions like the National Institute for Entrepreneurship and Small Business Development. You have the National Institute for Micro, Small, and Medium Enterprises, and the Indian Institute of Entrepreneurship, and the Indian Institute of Entrepreneurship or the Development Commissioner. So the MSMEs actually provide the largest share of employment after agriculture. The MSMEs, as I said, since they contribute nearly 8% to the country's GDP, although they contribute just 8% of the country's GDP, they employ a huge workforce. So hence, it is a very crucial part of the country's economy. So now, what are MSMEs? The MSMEs are basically mentioned under the Micro, Small, and Medium Enterprises Development Act, and they have been categorized into MSMEs that are into manufacturing and MSMEs that are into rendering of services. When we're talking about MSMEs that are into manufacturing, we're talking about different types of enterprises with different upper limits. So you have micro enterprises which have investments of up to 25 lakhs. You have small enterprises with investment of more than 25 lakhs and up to rupees 5 crores. And you have medium enterprises with investment of above rupees 5 crores and up to 10 crores. So here we're only talking about investment in plant and machinery. We're not talking about investment in land and building and all of that. We're only talking about investment in plant and machinery when we're talking about these figures. Similarly, you also have MSMEs which are into services, and these MSMEs are also categorized based on their investment amounts. And here you have micro enterprises which have investment of up to rupees 10 lakhs. You have small enterprises with investment of more than 10 lakhs and up to rupees 2 crores. You have medium enterprises with investment of 2 crores and up to 5 crores. So you have a small table which I think you can see in front of you, where we've categorized, where you see both the limits under the manufacturing enterprises and the limits under the services enterprises. So this is overall picture on the steps taken to improve the governance of micro, small, and medium enterprises after the dawn of the Companies Act. So what the various steps that are basically envisaged, the various processes that are envisaged after the coming into existence of the Companies Act 2013 are broadly as under. There could be a lot of other specific processes and small processes, etc., which have been put into place, but we are not dwelling on those for paucity of time. We will be taking you through the important changes that have been carried out which have an impact on the MSME sector. So having said that, Companies must put in place a mechanism to assist and monitor foreign travel of its directors to ensure that at least one director is resident in India for a total period of 182 days in the calendar year. So you need to ensure that it's a private company or the one person company or a small company, you need to ensure that one of your directors is in place, is in town for at least 182 days. You need to ensure that you have a strong mechanism to ensure adherence to the rules and regulations under the 2013 Act. We'll come to that in more detail a little later. You have to ensure that you obtain information from your independent directors to conclude whether their criteria of being independent have been met annually. This is because there are very stringent regulations for interested directors, so you need to ensure that none of the directors are interested in the activities of the company. The audit committee would need to devise a mechanism to form a policy for recommendation and appointment of auditors, and to review and monitor the auditor's independence, approve or modify related party transactions, and evaluate internal financial controls and risk management systems. So this is a pretty wide topic, and in short, what this act basically intends to do with respect to audit is that it wants to ensure that you have independent auditors and you have processes to check that they are actually independent. You also have processes to check that none of the auditors are related to the company in any way, and they're not interested in any of the activities of the company. You should also have processes to ensure that you have adequate financial controls and risk management systems. So, one of the processes is basically captured in the next sentence, where we're talking about the need by the board of directors to issue a director's responsibility statement. So this responsibility statement, among other things, requires also that companies have an adequate and effective compliance management system, which takes into consideration all applicable regulatory compliances for the organization. This is of paramount importance, if not for anything else, to ensure that the directors don't find themselves in jail. This is secondly of paramount importance because it gives both investors and shareholders the comfort that there are processes in place to ensure that the company is in compliance with all existing laws. So the violations that you can see are pretty stringent. If you don't have compliant management systems, if you don't have an effective compliance management system, which you find in the market, a lot of companies which are into outsourcing compliance management, like Explosion. So if you don't have a compliance management system of the kind that we guys use, and the type that we guys advise others to use, it could lead to a lot of penalties for the company. This could actually result in the company being fined a sum of rupees 25 lakhs and every officer in default being imprisoned for 3 years or fined up to rupees 5 lakhs. Now, having spoken about MSMEs, under the Companies Act, you have categories of companies. You have small companies, you have one-person company, and you have private companies. So logically, the kind of companies that would actually fall under the MSME umbrella are basically these three type of companies. So we will be talking about the compliances that need to be carried out again at a broad level for these three companies. So let's first of all see what a small company means. A small company is a company which has a built-up capital which does not exceed 50 lakhs and in any case should not be more than rupees 5 crores. Its turnover as per the last profit and loss account should not exceed rupees 2 crores and in any event it should not exceed rupees 20 crores. Hence a small company will cover, as per the limit that we earlier discussed, it will be covering a small and micro enterprise in the manufacturing category. It will be covering a small, micro and medium enterprise in the services category. important provisions under the new Act which could impact a small company. Now, before we go into that, we need to understand that there are some companies under the MSME which may, for remote reasons, not fall under the category of a small company. If the MSME is a public company, or if the MSME has a turnover that exceeds 2 crores or such high amount not exceeding rupees 20 crores. So when we're talking about a public company, what is a public company? A public company is one which has more than 200 members, has a minimum of at least 7 members, and has a minimum share capital of rupees 5 lakhs. So if the MSME has a paid-up share capital exceeding rupees 50 lakhs or rupees 5 crore, as the case may be, then it will not fall under the category of a private company or a small company or a one-person company, but rather it will be considered as a public company. Since we're not really dealing with the the compliances for a public company here, that has to either be taken offline or done in another session. We will mostly be concentrating. Of course, there will be certain compliances. In fact, all the compliances that will impact a public company, and there are more compliances that impact a public company. But we will actually be concentrating on a one-person company, a small company, and a private company. So, as I've already said, only a private company can be classified as a small company. A holding company, subsidiary company, charitable company, and company covered by any special act cannot be classified as a small company. So if you have a holding company, etc., holding a small company, that is not a small company. The status of a company as a small company actually changes from year to year. So sometimes a small company, by virtue of increasing its turnover, by virtue of increasing its paid-up capital, might actually go reach the level of a small company and become a normal private company. The benefits which are available during a particular year may not be available in the next year. What are the important provisions under the new Act for a small company? You need to see that the annual return of a small company is signed by the company secretary, or where there is no company secretary, by a single director of the company. The annual return has to be filed within 180 days of the completion of the AGM. A small company may hold only 2 board meetings in a year. That is, 1 board meeting in each half of the calendar year, with a minimum cap of 90 days between the 2 meetings. So the gap should not exceed 90 days. A small company need not include cash flow statements as a part of its financial statements, unlike a public company. A small company, or unlike even a private company, a small company, provisions regarding mandatory rotation of auditors and maximum term of auditors being 5 years in case of an individual and 10 years in case of a firm of auditors is not applicable to a small company. So you can keep an auditor as your auditor for any period of time. The merger process between two or more small companies is to be approved on a fast-track basis. The merger will require approval of the Register of Companies, the official liquidator, and members holding at least 90% of total shares, and the majority of creditors representing at least 9/10 of the value of the credit that is given to the company. And this actually has to be indicated in the meeting convened by the company by giving a 21-day notice along with the scheme to its creditors for the purpose of saying that this whole thing, that there's going to be a merger, and a 21-day notice has to be given. And this whole process has to be approved by the stakeholders that we just mentioned. Another important provision for a small company mandates that basically if you have one or more subsidiary companies, you need to prepare consolidated financial statements. However, a small company that will not have subsidiaries, so the question doesn't arise. However, for the purposes of this section, there is an explanation which states that a subsidiary includes associate and joint venture company. So if a small company has a subsidiary, has an associate or a joint venture company, then the small company also has to file a consolidated financial statement. Now we go on to a one-person company. What is a one-person company? The one-person company has certain thresholds which it should not reach. Basically, that its paid-up capital should not exceed 50 lakhs, or average turnover should not exceed 2 crores. And it can be incorporated by an Indian citizen who again is resident in India for at least 182 days during the preceding year. The company can fall within the categories of a micro or small enterprise in the manufacturing or services sector. Now, why do people opt for a one-person company? The main advantages are that it has a separate legal entity, it has a limited liability, it has perpetual succession, and registration is required. So, when we say a company has a separate legal entity, it has a legal entity, it has a legal identity that is different from that of its members. So if there is going to be a suit that is filed against the company, unless you actually include the directors of the company, the directors are not obliged to appear before court. So there is a different identity that is there for the company, and there is a different identity that is there for the members of the company. That is called a separate legal entity. You have limited liability. So if the paid-up share capital of the company is 50 lakhs, then that is the liability of the company. You cannot hold the company for a liability in excess of whatever is the share capital of the company. Perpetual succession. So it doesn't matter if the shareholders or directors of the company are alive or dead, irrespective of the fact whether they exist or not, the company continues to exist. So that is the meaning of perpetual succession. Registration is required under the Companies Act. A one-person company needs to be registered as a one-person company. There is a process for registration that has to be followed. So once a one-person company, in short an OPC, once it is registered under the Companies Act, it will attract specific corporate governance provisions, hence making it attractive to potential investors. So unlike a proprietorship, which potential investors might not be too concerned about, because a proprietorship doesn't look at compliances as closely as an entity that is organized under the Companies Act. The fact that an OPC has been registered by the Companies Act makes the entity far more attractive to potential investors. A one-person company, what are the important provisions? It needs to have at least one director. It can go up to 15 directors. But please understand, those 15 directors will not be members, they will just be directors. In case you want to have more than 15 directors, you need to ensure there's a special resolution that they are appointed pursuant to a special resolution. In case of an OPC having only one director, resolutions that need to be passed have to be recorded in the minutes book. In case there is more than one director, at least one board meeting must be held in each half of the calendar year, and the gap should not be more than 90 days. Financial statements can be signed by one person. Cash flow statement is not mandatory. Statements will have to be filed within 180 days of the close of the financial year, along with all the necessary documents. The board report will only need to comment on any qualification, reservation, or adverse remark made by any auditor. So you don't have to go into a major board report which dwells into all the all the areas which require to be highlighted on corporate governance and the activities of the company. You need to only highlight those issues where a qualification has been made, or the specific reservation, or there has been an adverse remark by the auditor. You need to give your comments against those points. Provisions regarding to general meetings will not apply to a one-person company. So basically the Companies Act has brought about stringent reporting requirements for MSMEs to be accountable, as though they have limited resources. These companies run larger risk. Good corporate governance gives MSMEs corporate credibility and wins corporate confidence, wins the investors' confidence. So some provisions which impact MSMEs are given. Just like any other company, MSMEs also need to have a corporate identification number, and it needs to have that corporate identification number put on its business heads, business letters, bill heads, etc. In addition to that, the name and address of the registered office will have to be specified. So this is a requirement that is currently existing for all MSMEs, in fact all companies. The gap between board meetings should not exceed 120 days. So this again applies to all companies. The resident director has to be present in the country for at least 182 days. So this is a compliance that is available, that needs to be carried out for all companies. Non-cash transactions involving the director requires shareholder approval. So if there is a certain transaction that involves the director or the director of the holding or subsidiary company or an associate company, or it involves a person who is connected with the director, then such transactions will require shareholder approval. And this is now applicable to all companies. It was earlier applicable only to public companies, it is now applicable to all companies. Loans to directors, except as a part of the conditions of service or under a scheme or otherwise permitted in other provisions of the Act. Basically, loans to directors are now prohibited. So one company cannot give a loan to its directors, either to its own directors or to a director who is the director of another subsidiary or affiliate or holding company. So all this comes under the scanner. If loans are granted, it has to be done after shareholder approvals. Loans to an investment in subsidiary also requires shareholder approvals if the limits on loans and investments exceed certain limits. However, there are some exemptions to this. For example, if the loan is given by an NBFC or if the loan is given by one company to another company, and it can be shown that the loan has actually been given after proper shareholder approvals have been obtained. Deposits. Earlier, private companies could take deposits from their directors, relatives, but now private companies can take deposits only from members. And even there are some limits that have been prescribed. So when I mean a private company, I've also made a one-person company and a small company. there is a provision which requires a mandatory corporate social responsibility spending of 2% for all companies which has a profit of more than 5 crores. So here, if a company has a profit of 5 crore or above, while it is expected that micro and small medium enterprises will not qualify, very small and medium enterprises will, while micro enterprises will not qualify, very small and medium enterprises will. Sorry for that slip. So basically, you have 1% companies, and you have small companies which might not be able to show a profit of 5 crores, but a lot of private companies will actually be doing it. So the Act encourages companies to spend at least 2% of the net profit over the previous 3 years on CSR activities. Now, we have some listed company provisions here. So although we're not really dealing with listed companies, the fact that you have a private company which has any security or debt instruments listed on a recognized stock exchange will make that private company a listed company. So although a private company does not actually have shares listed on the stock exchange, it could have securities of other nature like debt instruments, etc., which are listed. So if that is the case, then they will have to comply with a few additional requirements. So one is an audit committee requirement. So they need to have an audit committee which consists of a minimum of 3 directors, with independent directors forming a majority. Need to have a nomination and remuneration committee. They need to ensure that there is a secretarial audit which confirms that the company has complied with the provisions of several regulations, including the RBI, SEBI, CRA, Listing Agreement, Depositories Act, FEMA, etc. There has to be a vigilance mechanism that ensures that directors and employees send genuine concerns to the company. And when you're talking about vigilance mechanism, it is a little bit of the whistleblower principle, whereby if you find anything that is strangely wrong with a certain process, with a certain accounting process or a certain audit process, the same has to be brought to the notice of the person who has been appointed as the vigilance officer for the company. Appointment of auditors by rotation. Other compliances are basically that annual return has to be certified by the CS, and the company has to file with the ROC changes, if any, in the number of shares. The company has to place its financial statements on the company website. These are the additional compliances that a company will have to provide, although it is not listed on the stock exchange. So this is my short presentation. So as you can see, I'm not dwelled into the details. However, I have touched on the important compliances concerning the categories of company that we discussed. So I'll be happy to hear out your questions.
Hello.
Hello. Hi, Sonu. I'm done with my presentation.
Thank you, sir. Thank you so much for the wonderful presentations. I will now request all my participants to please punch in questions that if they have any. Sir will take just a minute for the participants to punch in questions. We'll just request your time for 1 more minute. Sir, we have one question.